Do you know why gold is the anti-fragile asset to own? Because it's money. If Morgan Stanley understood that, they would have had some gold before it reached all-time highs and above. How can you reach above all-time highs? Whatever. But now they're jumping in. You'll see other investment banks jump in. So let's take a look at how much money we're talking about if Morgan Stanley is going to shift its 60-40 portfolio, where its clients are now, to a 60-20-20. How much dollars, how many dollars is that? And before you tell me, well, they probably already did this or else they wouldn't be announcing it. Yeah, let's assume that's true. That still means that other investment banks that are bigger than Morgan Stanley are going to follow eventually and probably.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pin comment. Stay ahead of the curve. Don't miss out.
From bonds, which means that interest rates will go higher as investment banks follow each other with these recommendations because they are all a bunch of lemmings and they follow each other. My point is that they follow each other because that's how the business is. So Morgan Stanley is the first big investment bank to come out with this publicly. It's going to be followed by many others. So let's take a look at this article and then take a look at how much money would be going into gold if this CIO of Morgan Stanley is to be taken seriously. Morgan Stanley's CIO favors 60-20-20 portfolio strategy with gold as inflation hedge. This is by Mehnaz Yasmin, who I don't know what country he's from or she's from or whatever, but you have here these gold bars with those serial numbers. Isn't that beautiful? Gold. So here we're going to read the first three paragraphs and get the point. September 16th, Reuters. A 60-20-20 portfolio strategy that includes 20% gold is a more resilient inflation hedge at a time when U.S. equities are offering historically low upside over treasuries and investors are demanding higher yields for long-term bonds. Morgan Stanley Chief Investment Officer Mike Wilson on Tuesday. A 60-40 portfolio, which typically has 60% of its holdings in stocks and the remaining 40% in fixed income, which means debt, counts on moves in the two asset classes to offset one another, meaning one goes up, the other goes down. That's how it normally is, unless there's stagflation in the currencies imploding, which is probably what's happening now, which is why the CIO of Morgan Stanley is recommending 20% gold, because he sees the currency in collapse. He's not going to say that, but that's what he sees. Anyway, continuing with the sentence, with stocks strengthening amid economic optimism and bonds rising during turbulent times, that's how it's supposed to be with the 60-40, but it's not anymore because the currency is in collapse. Wilson, however, favors a 60% allocation to equities and 20% each to fixed income and gold. Within bond markets, the prominent Wall Street bear prefers shorter term duration treasuries of 5 years over the 10-year note to capture rolling returns along the yield curve. Gold is now the anti-fragile asset to own.
Silver price rockets from $42 to $46 on short squeeze momentum. Silver has delivered one of its most impressive performances of 2025, with prices rocketing from $42 to $46 in just 7 trading days. This sharp move caught many traders off guard and demonstrates the volatile nature that makes precious metals both exciting and unpredictable for investors. The recent price action shows all the classic signs of a short squeeze in motion. According to analyst Burak, when bearish traders get caught on the wrong side of a breakout, they're forced to buy back their positions at higher prices, which only adds more fuel to the upward momentum. This creates a self-reinforcing cycle where each wave of buying pushes prices even higher, forcing more shorts to capitulate. The speed of this rally has been particularly noteworthy, with silver gaining nearly 10% in such a compressed time frame. This type of aggressive move often indicates that significant structural changes are occurring beneath the surface of the market. Multiple factors have converged to create this perfect storm for silver prices. The primary driver appears to be short squeeze pressure, as traders who bet against the metal were caught off guard by the sudden breakout and forced to cover their positions. This technical factor has been amplified by broader macro demand for safe haven assets as investors seek protection against persistent inflation concerns and currency debasement risks. The current trajectory has silver pointed directly at the $50 psychological barrier. But history shows that short squeezes often lead to volatile corrections once the forced buying subsides. The key for sustained momentum will be whether buyers can maintain control above the $45 level, which would suggest genuine demand rather than just technical covering.
Annual report 2024, and it says here, look at this, investment management, AUM, that means assets under management, how many dollars worth of assets are under its management in these 60-40 portfolios that will end up being 60-20-20 portfolios. That is $1.666 trillion because it says 1,666, and you see here, here's the parentheses, billion, so $1,666 billion, 20% of that. Okay, so $333 billion. Let's assume that all went into gold already. So we have other banks that are bigger, like JP Morgan and Bank of New York Mellon. I don't think that's bigger than Morgan Stanley, but whatever. You have big banks. And obviously, all other banks in the world are going to follow Morgan Stanley eventually. So the 60-40 portfolio is going to become the 60-20-20 portfolio, and all the investment banks are going to invest if they haven't. This is the silver to S&P 500 ratio. You can see here that from 2000 to 2011, silver did handily outperform the S&P 500. But since 2011, when we last hit $50, the S&P 500 has vastly outperformed silver, also gold, and we haven't even broken through a trend line, which would start at 2016 over here, tagged it in 2020, and it has not been hit yet. So this has been the rally from whatever this tiny number is to whatever this tiny number is, 0.007. And we have shown you this chart in other videos, and also I cover it on my Substack on endgameinvestor.substack.com, where the all-time high in silver relative to the S&P was like something like 0.44. And here, if you take that into account, this number of about 0.04 is barely registered on the graph. But here, really, this is really nothing. This is nothing. Because if you invested in the S&P 500 and only just bought the SP 500 ETF month after month, reinvesting dividends, you would have vastly outperformed silver since 2011, even since 2008, and even since I think you would have tied about 2006. Whether you invested in the SP 500 or silver, you probably would have outdone silver with the SP 500 because S&P 500 will give you dividends, whereas silver won't, unless. Do you know why gold is the anti-fragile asset to own? Because it's money. If Morgan Stanley understood that, they would have had some gold before it reached all-time highs and above. How can you reach above all-time highs? Whatever. But now they're jumping in. You'll see other investment banks jump in. So let's take a look at how much money we're talking about if Morgan Stanley is going to shift its 60-40 portfolio, where its clients are now, to a 60-20-20. How much dollars, how many dollars is that? And before you tell me, well, they probably already did this or else they wouldn't be announcing it. Yeah, let's assume that's true. That still means that other investment banks that are bigger than Morgan Stanley are going to follow eventually, and probably